Before we dive in, a quick but crucial disclaimer. I am not a financial advisor, and this video is for educational and entertainment purposes only. The information provided here is not financial advice. Investing involves risk, including the potential loss of principal. All investment decisions should be made with the guidance of a licensed financial professional who can assess your individual situation. Okay, with that said, let's get started. I remember the first time I tried to open a stock account. I sat there staring at the screen and my brain just shut down. Roth IRA, taxable brokerage, ETF, margin. It felt like I'd stumbled into an exam for a class I didn't even know I was taking. It was a language designed to be confusing to keep people out. And for a minute I almost let it. I almost clicked the little X on the browser tab and told myself, I'll figure this out later. Sound familiar? If you've ever felt that investing is some secret club you weren't invited to, or that you need a finance degree just to get started, this video is your official invitation. This is your key to the front door. Because here's the brutal truth they don't teach you in high school. Just saving your money is a guaranteed way to lose. It's a slow, quiet financial death by 1,000 cuts called inflation. Imagine you have a $10,000 block of ice. That's your savings. Now, imagine the economy is a slightly warm room. Every single day, without you doing anything, a little bit of that ice melts away. That's inflation. Your $10,000 is still called $10,000, but it buys you less and less. The price of gas, groceries, rent, it all goes up. Your money's power, its ability to actually do things for you, is constantly shrinking. Let me make this real for you. If you had $10,000 in cash and you stuffed it under your mattress in the year 2000 today, that same $10,000 would only have the buying power of about $5,700. You lost almost half your money by doing absolutely nothing. You played it safe and you lost. That is the problem we are here to solve. This video isn't about getting rich quick. It's not about risky bets or trying to time the market. It's about turning the tables on inflation. It's about taking your hard-earned money and putting it to work, so it grows for you instead of melting away. It's about shifting your mindset from just a saver to an owner. When you buy a stock, even a tiny fraction of a share, you are becoming a part owner of a real business. You own a sliver of Apple or Amazon or Coca-Cola. You are participating in the growth of the American and global economy, not just watching from the sidelines. And today, we are taking the single most important step on that journey. This is the definitive step-by-step guide for a complete beginner in the United States to open their very first stock account with confidence. We're going to demystify the entire process. By the time you're done watching, you will know exactly what kind of account is right for you, which company to open it with, and what documents you need to have ready. We'll walk through the application so you don't get stuck. And I'll reveal the #1 mistake that trips up almost every single beginner. But first, let's kill the 3 biggest myths that keep people paralyzed on the sidelines. Myth number 1. I don't have enough money to start investing. This might have been true 20 years ago when you needed thousands of dollars and had to pay a broker a $100 commission just to buy a stock. Today, that is completely false. We live in the age of zero commission trading and something called fractional shares. This means you can start with as little as $5. You don't have to buy a full $200 share of a company. You can buy $5 worth and you'll own a small fraction of that share. The barrier to entry is no longer money. It's knowledge. Myth number 2. It's too complicated. I'm not a math genius. You absolutely do not need to be a math whiz. You don't need to read complex financial charts or analyze quarterly earnings reports. For most people, the best strategy is incredibly simple. It involves buying 1 or 2 broad market index funds and just letting them grow over time. If you can operate a smartphone app, you have all the technical skill you need to start building long-term wealth. We're not trying to be Wall Street traders. We're trying to be smart, long-term investors. There is a huge difference. And that leads to myth number 3. Investing is just gambling. It's like a casino. This is the most dangerous myth of all. Yes, if you are day trading, trying to jump in and out of stocks every few hours, you are gambling. That is not what we are doing. Long-term investing in the broad stock market is the polar opposite of gambling. In a casino, the odds are mathematically stacked against you over the long run. The house always wins. With long-term investing in the U.S. stock market, history has shown that the odds are overwhelmingly stacked in your favor. Over any 20-year period in its history, the S&P 500, which is just a basket of the 500 largest U.S. companies, has never lost money. It's a bet on human innovation, economic growth, and the success of the world's best companies. It's the most calculated, odds-on-your-side financial decision a person can make. So, how do we actually do this? The very first thing you need is a place to hold your investments. This place is called a brokerage account. The simplest way to think about it is this: it's like a special kind of bank account. Your checking account holds cash for your daily expenses. Your savings account holds cash for emergencies. A brokerage account is a container designed specifically to hold your assets, your stocks, your bonds, your funds. It's the wallet for your investments. You open this account with a company called a brokerage firm like Fidelity, Charles Schwab, or Vanguard. These are the secure, regulated, and insured platforms where you will buy and manage your assets. This brings us to the two fundamental questions you must answer before you even think about picking a single stock or fund. Answering these two questions correctly, right at the start, will save you thousands of dollars and countless headaches down the road. Question 1. What type of account should I open? Question 2. Where should I open it? Which company is best for me? Let's tackle question 1 right now because it's the most critical. The type of account you choose has nothing to do with what you can invest in. You can buy Apple stock in any of them. The difference is all about one thing: taxes. How and when you pay taxes on your investment growth. The government has created special accounts to encourage you to invest for your future, and they give you huge tax breaks for doing so. For a beginner, there are really only 3 main accounts you need to know about. First is the standard individual taxable brokerage account. This is the most basic and flexible. You put money in, it grows, and when you sell your investments for a profit, you pay capital gains tax on that profit. It's simple. There are no limits on how much you can contribute, and you can pull your money out whenever you want. This is a great account for financial goals that happen before retirement, like saving for a down payment on a house in 10 years. Next, we enter the magic world of retirement accounts. The two you need to know are the IRA, or individual retirement arrangement. The first is the traditional IRA. The big benefit here is a potential tax deduction today. You contribute money, and you might be able to deduct that amount from your income, lowering your tax bill this year. The money then grows tax-deferred, meaning you don't pay any taxes on the growth year after year. The catch? When you pull the money out in retirement, you pay ordinary income tax on every dollar you withdraw. So, you get a tax break now in exchange for paying taxes later. But for most young people and new investors, the holy grail, the undisputed champion of retirement accounts, is the Roth IRA. The Roth IRA flips the traditional IRA on its head. You contribute money that you've already paid taxes on, so there's no tax deduction today. But here's where the magic happens. That money grows completely 100% tax-free. And when you withdraw it in retirement, every single penny, your original contributions and all the decades of growth, is 100% tax-free. Let me say that again because it is the most important sentence you will hear all day. Tax-free growth and tax-free withdrawals in retirement. Imagine 2 people. They both invest $500 a month for 40 years and get the same return. The person with the traditional IRA turns that into, say, $1.5 million. But when they retire, every withdrawal is taxed. A huge chunk of their nest egg goes to the IRS. The person with the Roth IRA also has $1.5 million. And when they retire, that money is all theirs. The government can't touch it. It is, without a doubt, the single greatest wealth-building tool the United States government has ever given to the average person. If you are eligible for a Roth IRA, you should be doing everything in your power to fund it. We're going to talk about eligibility and contribution limits in a bit, but for now, just understand its incredible power. Your future self will thank you for it. So what's the catch? If the Roth IRA is this magical wealth-building machine, why doesn't the government just let everyone pour all their money into it? Well, that's the thing. They don't. They put very specific rules on it because they know just how powerful it is. This isn't a loophole. It's a gift. A gift with an instruction manual. And right now, we're going to read the most important pages of that manual together. First, to contribute to a Roth IRA, you need to have what the IRS calls earned income. This is just a fancy way of saying you have to have a job. Money you get from working, whether it's a W-2 job, a side hustle, freelancing, or running your own small business, that's earned income. Money you get from unemployment benefits, Social Security, or just from your investments themselves. That doesn't count. The government wants to see that you're actively earning money in the year you want to contribute. It's their way of rewarding workers. The second, and for some people the trickiest rule, has to do with how much you earn. There's an income limit. If you make too much money in a single year, the government says, sorry, this amazing tax shelter isn't for you. For 2024, if you're single and your modified adjusted gross income, we'll call it MAGI for short, is over $161,000, you can't contribute a single penny. If you're married and filing your taxes jointly, that limit is $240,000. Now, don't let the term modified adjusted gross income scare you. For most people, it's going to be very close to the adjusted gross income, or AGI, you see on your tax return. It's basically your total income minus a few specific deductions. The key takeaway is this: the Roth IRA is primarily designed for low to middle income earners. It's a tool specifically created to help regular people build extraordinary wealth. If you're just starting your career, or you're anywhere in that vast middle class range, you are the exact person this was made for. So, if you have earned income and you're under the income limit, how much can you actually put in? This is the third rule: the contribution limit. For 2024, the maximum you can contribute to your Roth IRA is $7,000. If you're age 50 or older, the government lets you play a little catch-up, allowing you to contribute an extra $1,000 for a total of $8,000. This limit is the total for all of your IRAs combined. You can't put $7,000 in a Roth and another $7,000 in a different IRA in the same year. It's $7,000 total. And while that might not sound like a life-changing amount of money, remember what we talked about. $7,000 a year, invested wisely over decades in a tax-free paradise. That is how you build a seven-figure, or even multi-seven-figure, nest egg. Now, what if you're on the fence? Or what if you make too much money for a Roth IRA? Does that mean you're out of luck? Not at all. This brings us to the Roth IRA's older, more traditional sibling, the traditional IRA. It works in the exact opposite way when it comes to taxes, and for some people that's a better deal. Think of it like this: with a Roth IRA, you pay your taxes now. The money you put in has already been taxed as part of your regular income. The government gets its cut today. In exchange, they promise to never ever tax you on that money or its growth ever again. You are prepaying your tax bill to the future. With a traditional IRA, you do the opposite. You get your tax break today. The money you contribute to a traditional IRA can often be deducted from your taxable income for the year. So if you make $60,000 and you put $7,000 into a traditional IRA, you might only pay income tax on $53,000. This lowers your tax bill right now, which feels great. But there's no free lunch. The deal you're making is that you will pay income taxes on every single dollar you pull out in retirement, both your original contributions and all the growth. You are deferring your tax bill to the future. So which one is better? It's the great debate. Pay taxes now or pay taxes later? The simple answer is, it depends on whether you think your tax rate will be higher now while you're working or later when you're retired. If you're young and in a low tax bracket, the Roth is almost always the better choice. Pay those low taxes now and enjoy tax-free withdrawals when you're older and likely in a higher bracket. If you're in your peak earning years in a high tax bracket, and you expect your income, and thus your tax rate, to be much lower in retirement, the traditional IRA becomes more attractive. You get a nice tax deduction when it saves you the most money. Okay, so we have the Roth IRA and the traditional IRA. These are personal accounts you open yourself. But there's another, incredibly powerful account that millions of Americans have access to and don't even use properly. The workplace retirement plan, most commonly known as the 401k. If your employer offers a 401k, you need to pay very close attention, because this could be the single most important wealth-building tool at your disposal, for one simple reason: the employer match. This is the closest thing to a 100% guaranteed return in the entire world of finance. It is literally free money. Many companies will offer to match your contributions up to a certain percentage of your salary. A common offer is something like, "We will match 100% of your contributions up to 3% of your salary, and 50% of the next 2%. Let's break that down with a real-world example. Say you make $50,000 a year. A 100% match up to 3% means if you contribute 3% of your salary, which is $1,500, your company will put in another $1,500 for free. Instantly, your $1,500 has become $3,000. You have made a 100% return on your money before it has even been invested for a single day. There is nowhere else on planet Earth you can find a deal that good. If you contribute up to 5%, that's $2,500, they'll match the first 3% fully, that's $1,500, and then 50% of the next 2%, that's another $500. So you put in $2,500, and your company gives you $2,000 for free. Not contributing enough to get your full employer matches, without exaggeration, like taking cash out of your paycheck and lighting it on fire. Before you even think about opening any other investment account, your absolute first priority should be to contribute enough to your 401k to get every single penny of that free match. Just like IRAs, many companies now offer two flavors of 401k: a traditional 401k and a Roth 401k. And the logic is exactly the same. With a traditional 401k, your contributions are pre-tax, lowering your taxable income today, but you'll pay taxes on withdrawals in retirement. With a Roth 401k, you contribute with after-tax dollars, but your qualified withdrawals in retirement are 100% tax-free. So we have these incredible tax-advantaged retirement accounts: the IRA, the Roth IRA, the 401k. These are your heavy hitters. They are the foundation of your financial fortress. You should be using these accounts to the absolute maximum of your ability. But what if you do? What if you max out your IRA for the year, and you're contributing as much as you can to your 401k, and you still have money left over that you want to invest? Or what if you want to invest for a goal that isn't retirement, like a down payment on a house in 5 years, or a new car? This is where our final type of account comes in. This is the workhorse, the bread and butter account that most people think of when they hear stock market. It's the standard taxable brokerage account. There are no special tax tricks here. There are no contribution limits. There are no income limits. There are no rules about when you can take your money out. It is the most flexible, most straightforward investment account there is. You open it, you fund it with your after-tax money, and you can buy and sell investments to your heart's content. But because it's so flexible, it doesn't get any of the special tax treatment. When you sell an investment for a profit, you have to pay taxes on that profit. It's called a capital gains tax. If you receive dividends from your stocks, you have to pay taxes on those dividends. This is why, for long-term retirement savings, you always want to prioritize your IRA and 401k first. Filling those tax-sheltered buckets before you put a single dollar into a taxable brokerage account is one of the smartest financial moves you can ever make. So, to recap, we have 4 main doors into the world of investing. The Roth IRA, your tax-free paradise for retirement. The traditional IRA, for a tax break today. The 401k, your workplace superpower with its free money employer match. And the taxable brokerage account, your flexible do-anything account for everything else. Understanding which door is right for which goal is half the battle. Now you know the types of accounts. But this leads to the most important question of all. Where do you actually go to open one? Which company do you trust with your hard-earned money? Because they are not all created equal. The brokerage you choose can have a massive impact on your success, and picking the wrong one can quietly siphon away thousands, even tens of thousands of dollars from your returns over your lifetime through hidden fees and bad technology. Choosing the right platform is critical, and the biggest, most famous names aren't always the best choice for a beginner. So let's break down this decision. Think of choosing a brokerage like choosing your first car. You've got the old reliable giants, the Fords, the GMs, the Toyotas of the investing world. These are your Fidelities, your Charles Schwabs, your Vanguards. They've been around for decades, they're trusted by millions, and they offer just about every feature you can imagine. They are massive, financially sound institutions that hold trillions of dollars in customer assets. For many, this is the safest, most logical choice. But then you have the new guard. The Teslas, the Rivians of the brokerage world. These are your Robinhoods, your Webuls, your M1 Finances. They burst onto the scene with sleek, mobile-first apps, zero-commission trading, and a promise to democratize investing for everyone. They're flashy, they're easy to use, and they've completely changed the game. So which car do you buy? The reliable sedan or the slick electric vehicle? The answer depends entirely on what you, the driver, actually need. And to figure that out, we need to look under the hood at 5 key areas. The first, and by far the most important, is fees. This is the silent killer of investment returns. 20 years ago, if you wanted to buy a stock, you'd call up a broker and pay him $100 for the privilege. Then online brokers came along and dropped that to $10 or $20 per trade. Today, thanks to the intense competition from the new guys, nearly every major brokerage in the USA offers zero-commission trading on stocks and ETFs. This is a monumental win for the small investor, but it has created a dangerous misconception. People hear zero commission and they think free. It is not free. Let me say that again, it is not free. Brokerages are businesses, not charities. They have to make money somehow, and the ways they do it can be a little opaque. One of the most common ways is something called payment for order flow, or PFOF. It sounds complicated, but the concept is simple. When you place an order to buy $100 of Apple stock on a free trading app, that app doesn't just send your order straight to the New York Stock Exchange. Instead, they often sell your order to a massive high-frequency trading firm, a market maker, who then actually executes the trade for you. These firms pay the brokerage a tiny fraction of a cent for every share you trade. It doesn't sound like much, but when you have millions of users making millions of trades, it adds up to billions of dollars in revenue. Now, is this a bad thing? The industry is fiercely divided. The brokerage will tell you it's what allows them to offer you commission-free trading. Critics will argue that the market maker might not be giving you the absolute best possible price on your stock. Maybe you pay a penny more per share than you otherwise would have. This tiny difference is called the spread. Again, a penny doesn't sound like much, but over a lifetime of investing, those pennies can turn into thousands of dollars you never even knew you lost. The big, traditional brokers like Fidelity and Vanguard historically have not relied as heavily on this business model, often touting their superior trade execution. This is a subtle but potentially significant difference. Beyond that, you have to watch out for other fees. Are there account maintenance fees if your balance drops too low? Are there fees to transfer your account to another brokerage if you decide to leave? What about fees for things like paper statements or wire transfers? Read the fine print. The best brokerages for beginners have a clear, simple fee structure with zero account minimums and zero maintenance fees. The second criterion is account minimums. This used to be a huge barrier. You'd go to open an account and they'd say, "Great, we just need a minimum deposit of $5,000. For most people just starting out, that was a non-starter. Today, this is largely a solved problem. Almost all of the major players, both old and new, allow you to open an account with $0. You can literally start by depositing $25 from your next paycheck. This is fantastic. But there's a related concept here that's equally important: fractional shares. Let's say you want to invest in Amazon, but one share costs over $100. Or maybe you want to buy into Chipotle, but a single share costs thousands. In the old days, you were out of luck until you could save up enough to buy a full share. With fractional shares, you can buy a small slice of a share. You can invest just $50 into Amazon or even $5. This is an absolute game changer for beginners. It allows you to build a diversified portfolio of many different companies, even with a very small amount of money. Not every brokerage offers this, but most of the beginner-friendly ones do. It's a feature you should absolutely insist on. Third on our list is the menu of investment options. Think of this as the difference between a high-end restaurant with a massive menu and a simple food truck. The food truck might only do one thing like tacos, but it does it really, really well. The restaurant gives you endless choice. Some of the newer app-based brokers are like the food truck. They primarily offer US stocks and ETFs. For 95% of beginners, this is more than enough. It's simple, it's clean, and it gets the job done. The big, established brokerages are the massive restaurants. They offer everything: stocks, ETFs, mutual funds, bonds, CDs, international stocks, options, futures, the list goes on. As a beginner, you might look at that and feel overwhelmed. You don't need access to pork belly futures right now. But 5 or 10 years from now, as you become more sophisticated, you might want to invest in a specific mutual fund that your app-based broker doesn't offer. Or maybe you'll want to buy individual bonds. Having to sell all your investments and move your account to a new brokerage just to access these things is a huge pain. So, there's a case to be made for starting with a platform that you can grow into even if you don't use all the features on day one. This leads directly into our fourth point: the user experience and the research tools. This is the cockpit of your investment vehicle. Are you sitting in a hyper-complex fighter jet with 1,000 buttons and dials? Or are you in a modern car with a clean, intuitive touchscreen? There is no right answer here. It's about what makes you a confident driver. Platforms like Charles Schwab's thinkorswim or Interactive Brokers are the fighter jets. They are beloved by professional day traders because they offer an incredible depth of data, charting tools, and analytics. For a beginner, opening this up is like trying to read a different language. It can be terrifying and lead to analysis paralysis, where you're so overwhelmed with information that you end up doing nothing. On the other end of the spectrum, you have apps like Robinhood or Public. Their interfaces are beautiful, simple, and intuitive. Buying a stock is as easy as ordering a pizza. This is fantastic for getting started and building the habit of investing. The danger, however, is that it can feel too much like a game. The confetti animations, the social feeds, the constant notifications, they can encourage frequent, impulsive trading rather than long-term, disciplined investing. The sweet spot for many beginners lies in the middle. A platform like Fidelity or Schwab's main app. They're not as intimidating as the pro-level software, but they offer robust, free research tools, like analyst reports from Morningstar and S&P, that can help you learn and make informed decisions. They give you the steering wheel and the gas pedal, but they hide most of the complex engine components unless you go looking for them. Finally, our fifth criterion: customer support. This is the one nobody thinks about until something goes wrong. And when it comes to your life savings, something eventually will go wrong. You'll have a question about a tax form. A deposit will be delayed. You'll get locked out of your account. In that moment of panic, do you want to be arguing with an unhelpful chatbot, waiting 72 hours for an email response? Or do you want to be able to pick up the phone and speak to a knowledgeable human being in the United States within 2 minutes? This is often a major differentiator between the new guard and the old guard. The big, established firms have massive, US-based call centers. They have physical branch locations you can walk into. The newer, leaner companies often rely on email or app-based support to keep their costs down. For some, that's a fine trade-off. For others, knowing you can get a person on the phone provides invaluable peace of mind. So to recap: fees, account minimums, investment selection, user experience, and customer support. These are the 5 lenses through which you need to evaluate any potential brokerage. It's not about which one is the best, but which one is the best for you right now. The flashy sports car might be fun, but if you just need to get to work safely every day, the reliable sedan is the smarter choice. Don't let a clever marketing campaign or a free stock promotion make this critical decision for you. This is the foundation of your entire financial future. You need to choose a partner you can trust for the long haul. So let's talk about those partners. In the United States, when it comes to long-term, reliable brokerage firms, there are 3 names that stand above all others. The Titans, the gold standard. They are Fidelity, Charles Schwab, and Vanguard. If you're serious about building wealth over decades, your decision will almost certainly come down to one of these 3. Think of them as the Honda Accord, the Toyota Camry, and the Subaru Outback of the financial world. They are all incredibly reliable, safe, and will get you where you need to go for a very long time. They just have slightly different philosophies and excel in different areas. Choosing between them isn't about picking a good one and avoiding a bad one. It's about picking the one whose personality best matches yours. Let's start with the philosophical giant, Vanguard. To understand Vanguard, you have to understand its founder, the legendary John C. Bogle. Bogle was a man on a mission. He believed Wall Street was fundamentally broken, designed to enrich the brokers and the fund managers, not the actual investors. He saw a system filled with high fees, complex products, and a culture of speculation that was actively harming the average person's ability to save for retirement. So he did something truly revolutionary. He created a company that was owned by its own funds, which in turn are owned by you, the investors. This isn't just some marketing gimmick. It's the entire legal structure of the company. Vanguard has no outside stockholders to please. There are no Wall Street analysts demanding higher profits next quarter. Their one and only master is you, the client. This unique structure means their primary goal isn't to maximize profit. It's to minimize costs for you. This is why Vanguard is famous, almost evangelically so, for its low-cost index funds. Bogle's big idea was simple. Instead of trying to beat the market, which very few people can do consistently, just buy the whole market through a low-cost index fund and hold on. Vanguard is the physical embodiment of that philosophy. Their platform is simple, some might even say a bit dated. It's not flashy. It's not designed to get you to trade every day. It's designed to make it easy to buy and hold low-cost, diversified funds for the rest of your life. So who is Vanguard for? It's for the purist. The set-it-and-forget-it investor who believes in the Boglehead philosophy. If you just want to automatically invest in a few core index funds every month and not think about it for 40 years, Vanguard is arguably the best place on earth to do it. Next up is Charles Schwab. If Vanguard was the philosophical revolution, Schwab was the populist revolution. Before Chuck Schwab came along, investing was an exclusive club for the wealthy. You had to go through a stuffy broker in a suit who charged you exorbitant commissions just to buy a single share of stock. Schwab shattered that model. He was the original discount broker. He used technology to slash commissions and opened the door for Main Street to invest right alongside Wall Street. That spirit of customer empowerment is still the core of their DNA today. While Vanguard is famous for its structure, Schwab is famous for its service. They consistently win awards for customer support. If you have a problem, you can call them and talk to a knowledgeable human being quickly. They have physical branches you can walk into. They offer a massive range of investment options, from their own excellent low-cost index funds to stocks, bonds, and options. Their platform, including their Street Smart Edge software, is powerful and packed with research tools. They are a fantastic all-around choice. They've also become a leader in the banking world, with a checking account that's beloved by travelers for having no foreign transaction fees and refunding all ATM fees worldwide. So, who is Charles Schwab for? It's for the investor who wants a great balance of everything. You get low costs, a huge selection of products, powerful tools, and critically industry-leading customer support. If you value the peace of mind that comes from knowing you can easily get help when you need it, or if you want your banking and investing all under one trusted roof, Schwab is an incredibly compelling choice. Finally, we have Fidelity. If Vanguard is the philosopher and Schwab is the customer champion, Fidelity is the tech-savvy innovator. Fidelity is a privately owned behemoth that has consistently pushed the industry forward through technology and competition. They were one of the first to offer a user-friendly website. They were a pioneer in mutual funds. And today they are arguably the most forward-thinking of the big three. Their mobile app is slick, modern, and incredibly easy to use. It's often considered the best in the business among the major brokerages. They were the first major firm to introduce zero-expense ratio index funds. That's right, funds that cost you literally nothing to own. It was a massive shot across the bow to the entire industry. They are also a leader in offering fractional shares. This is a game changer for new investors. It means you don't need $3,000 to buy one share of Amazon. You can buy just $10 worth if that's all you have. This lowers the barrier to entry and allows you to build a diversified portfolio, even with a small amount of money. Their platform is packed with educational resources, screeners, and research tools that are both powerful and accessible to beginners. So, who is Fidelity for? It's for the modern tech-savvy investor who wants the best digital experience. If you live on your smartphone, if you appreciate a clean user interface, and if you want access to cutting-edge features like zero-fee funds and broad fractional share trading, Fidelity is likely going to feel like the most natural fit. Now, you might be thinking, what about all those other apps I see advertised everywhere? The Robinhoods, the Webuls, the M1 Finances of the world. These are the new guard, and they've played a huge role in getting a new generation interested in investing, which is a fantastic thing. They excel at user interface design, making investing feel like a simple, even fun game on your phone. And for that, they deserve credit. However, it's crucial to understand their business model is often different from the big three. Many of them make a significant amount of money through something called payment for order flow, or PFOF. In simple terms, they take your order to buy a stock and sell it to a high-frequency trading firm, a market maker, who then executes the trade. The market maker pays them for that volume. While this is a complex topic, critics argue it can create a conflict of interest, where the broker is incentivized to encourage high-frequency trading rather than long-term investing. These platforms are often designed to increase engagement, to get you to open the app to check your stocks to make a trade. The confetti, the slick animations, the easy access to complex products like options, it's all built to feel exciting. But long-term wealth building is supposed to be boring. It's not a video game. For many people, these apps can be a great starting point, but as their portfolio grows, they often find themselves graduating to one of the big three for their more robust tools, better customer service, and a platform philosophy that feels more aligned with long-term wealth creation than short-term trading. So, how do you make the final call? You can't go wrong with Fidelity, Schwab, or Vanguard. It's like choosing between 3 A+ students. The best thing to do is go to their websites, download their apps, get a feel for the interface. Does it make sense to you? Does it feel intuitive? Think about what matters most to you. Is it the absolute lowest cost and purest philosophy? Go Vanguard. Is it world-class customer service and a great all-in-one banking and investing solution? Go Schwab. Is it the best technology, a slick mobile app, and innovative features like zero-fee funds? Go Fidelity. There is no wrong answer here. The most important step is to simply choose one of these pillars of the industry, because once you've chosen your trusted partner, you can move on to the next critical question, which is not just where you'll invest, but inside what kind of account you'll be doing it. And this decision has massive implications for how much you'll pay in taxes and how fast your money can truly grow. We're talking about the difference between a standard brokerage account, a Roth IRA, and a traditional IRA. Understanding this choice is one of the most powerful financial secrets you will ever learn. Let's start with the one you see in movies, the one you probably think of when you hear stock market. This is the standard taxable brokerage account. Think of this as your financial Swiss Army knife. It's the most flexible, the most straightforward, and it has the fewest rules. You open it, you link your bank account, and you transfer in money that you've already paid income tax on. From there, you can buy and sell stocks, ETFs, mutual funds, whatever you want, whenever you want. If you need that money back next week to fix your car, you can sell your investments and get it. If you want to save up for a down payment on a house in 5 years, this is a great place to do it. There are no limits on how much you can put in, and no age restrictions on when you can take it out. So what's the catch? Why doesn't everyone just use this? The catch has 2 words: capital gains. Every time you sell an investment for a profit inside this account, that profit is a capital gain. And the government wants its cut. You made $1,000? Great. Now set aside a piece of that for taxes. This tax drag, this constant skimming off the top of your profits, acts like a parachute on your money's growth. It slows down the magic of compounding. Over a few years, it's noticeable. Over a few decades, it is a colossal difference. This is the pay-as-you-go plan. It offers maximum freedom, but that freedom comes at the price of tax efficiency. Now let's enter a different universe. The universe of retirement accounts. The government knows that most people aren't great at saving for their distant 70-year-old selves. So, they created a powerful incentive, a special deal to encourage you to lock money away for the long term. These accounts are called IRAs, or individual retirement arrangements. And they come with what can only be described as tax superpowers. The deal is simple. You agree not to touch the money until you're 59.5 years old, and in exchange, the government gives you a massive tax advantage that can be worth hundreds of thousands, or even millions of dollars over your lifetime. There are 2 main heroes in this universe: the Roth IRA and the traditional IRA. They are both powerful, but they work in opposite ways. First up, the fan favorite, the one you've probably heard whispered about in finance circles, the Roth IRA. The concept is so beautiful, so powerful, it almost feels like a cheat code for building wealth. With a Roth IRA, you contribute money that you've already paid taxes on, just like the standard brokerage account. But here's where the magic happens. Once that money is inside the Roth IRA, it can grow and compound for decades, completely 100% tax-free. When you hit retirement age and start taking that money out, every single penny is yours. The initial amount you put in, the dividends it earned, the massive growth it experienced over 40 years, all of it comes to you with a $0 tax bill. Let me say that again because it is the single most important concept to grasp. You pay your taxes on the seed, and the entire forest that grows from it is yours forever, untouched by the IRS. Imagine you contribute $6,000 a year for 30 years. That's $180,000 of your own money. But with average market returns, that account could be worth over $1 million by the time you retire. In a standard brokerage account, the roughly $800,000 in profit would be hit with a massive capital gains tax bill. But in a Roth IRA, that $1 million is all yours. You pay nothing. This is especially powerful if you believe that tax rates in the United States are likely to be higher in the future than they are today. You're locking in today's tax rates on your contributions and making all your future growth immune to any tax hikes down the road. It's an incredible deal. Now let's talk about its counterpart, the traditional IRA. This account operates on the complete opposite principle. Its slogan is, "Get a tax break now, pay taxes later." With a traditional IRA, you often contribute pre-tax money. This is the superpower. When you contribute, say, $6,000 into a traditional IRA, you may be able to deduct that entire amount from your taxable income for that year. So if you earn $70,000 for tax purposes, it's like you only earned $64,000. This immediately lowers your tax bill for the current year, putting more money back in your pocket right now. Your money then grows inside the account tax-deferred, meaning you don't pay any capital gains taxes year after year as it grows. So what's the catch this time? The catch is on the back end. When you retire and start withdrawing that money, every single dollar you take out, your original contributions and all the growth, is taxed as ordinary income. You got the tax break up front, but now it's time to pay the piper. You're essentially deferring your tax bill for decades, letting that untaxed money work for you the entire time, and then settling up with the government in retirement. So this brings us to the ultimate question. Which one is better? A Roth IRA where you pay taxes now, or a traditional IRA where you pay taxes later? The answer depends entirely on a bet you're making about your own future. The core question is this: do you expect to be in a higher or lower tax bracket in retirement than you are right now? If you are young, just starting your career, maybe making less than you hope to in the future, your current income tax rate is likely the lowest it will ever be. In this case, the Roth IRA is often the clear winner. It makes perfect sense to pay taxes now while your rate is low, and then let all your future growth be tax-free, especially when you're in your peak earning years and potentially higher tax brackets later in life. You take the small tax hit today to avoid a giant tax hit tomorrow. However, if you are currently in your peak earning years in a high tax bracket, and you expect your income and therefore your tax bracket to be much lower in retirement, the traditional IRA becomes very attractive. You get a significant tax deduction now when you need it most because your tax rate is high, and you'll pay the taxes later in retirement when your income and tax rate are presumably much lower. You're essentially shifting your tax burden from your high tax years to your low tax years. For the vast majority of people watching a video about opening their first stock account, the Roth IRA is the undisputed champion. You are likely at the beginning of your financial journey, and the ability to build a completely tax-free nest egg for your future self is a gift that is impossible to overstate. So, how does this all fit together? Does this mean you can only choose one? Absolutely not. The best strategy for many people is a hybrid approach. Think of it like this. The Roth IRA is for your 65-year-old self. It is your number one top priority long-term wealth building machine. The government puts a limit on how much you can contribute each year. And the first goal for many savvy investors is to contribute the maximum amount to their Roth IRA every single year without fail. But what about your other goals? The house down payment in 7 years? The new car? The I want to quit my job and travel for a year fund? That's where the standard taxable brokerage account comes in. After you've maxed out your contribution to your retirement account, you can put any additional investment money into your standard brokerage. This gives you the best of both worlds. You have your superpowered tax-free retirement engine working for you for the long haul, and you have your flexible, accessible Swiss Army knife account for all of life's medium-term goals. You are simultaneously planning for the distant future while actively building wealth for the near future. This two-account strategy, a Roth IRA for retirement and a standard brokerage for everything else, is one of the most effective and popular wealth-building blueprints in existence. You've now learned the single most important strategic secret to investing. It's not about which stock to pick. It's about choosing the right arena to play in. The standard account gives you flexibility, but you pay taxes on the go. The traditional IRA gives you a tax break today, but you pay later. And the Roth IRA lets you pay taxes on the small seed today, so the giant tree of wealth you grow is yours, completely and forever tax-free. So you've chosen your weapon, but which blacksmith do you trust to forge it? We're about to break down the biggest names in the game: Fidelity, Vanguard, Charles Schwab, and the new school apps like Robinhood and Webull. Choosing the right one can save you thousands in hidden fees and unlock tools that give you a serious edge. You won't want to miss this. Alright, let's break down this heavyweight championship match. In one corner you have the titans, the legacy brokers Fidelity, Vanguard, and Charles Schwab. These are the institutions your parents probably used. They manage trillions, that's trillions with a T, of dollars. They're established, they're trusted, and they are incredibly powerful. In the other corner you have the disruptors, the new school apps, Robinhood and Webull. They're sleek, they're mobile first, and they completely changed the game by making commission-free trading the industry standard. Let's start with the titans. Think of Fidelity as the ultimate all-rounder. It's like the decathlete of the brokerage world. It's fantastic for a brand new beginner, but it also has the powerful tools that a seasoned pro would need. Their website and app are clean, intuitive, and easy to navigate. But here's their killer feature for beginners. Fidelity offers its own line of zero-fee index funds. That means you can invest in a basket of the entire US stock market, for example, and pay literally 0% in management fees. That is unheard of. Over decades, that single feature can save you tens of thousands of dollars. They also offer fractional shares for almost any stock or ETF, meaning you can invest in Amazon with just $1, instead of needing thousands to buy a full share. For 90% of new investors, Fidelity is arguably the safest, most powerful, and most user-friendly choice you can make. It's the gold standard for a reason. Next up is Vanguard. If Fidelity is the all-rounder, Vanguard is the long-distance marathon runner. It was founded by the legendary John Bogle, the inventor of the index fund, and its entire philosophy is built around low-cost, long-term investing. Their unique structure is their superpower. Vanguard isn't owned by public shareholders. It's owned by its own funds. And who owns the funds? You do, the investor. This means the company is literally structured to work in your best interest, primarily by keeping costs as low as humanly possible. If your goal is to simply buy broad market ETFs or mutual funds, contribute money every month, and not look at it for 30 years, a strategy one highly recommend, then Vanguard is your temple. The trade-off? Their user interface, their app and website, have historically been a bit clunky. It feels more like a banking website from 2010 than a slick modern app. They've been improving it, but it's definitely built for function over form. For the pure, set it and forget it investor, Vanguard is an unmatched champion of low costs. Rounding out the titans is Charles Schwab. If Fidelity is the all-rounder and Vanguard is the specialist, Schwab is the premium, full-service experience. They are renowned for their world-class customer service. When you have a problem, you can call and get a knowledgeable human on the phone fast. That peace of mind is invaluable. Schwab also provides some of the best research and educational tools in the business, which is fantastic when you're just starting to learn. And here's the game changer. Schwab acquired TD Ameritrade, and with it, the legendary trading platform called thinkorswim. It's one of the most powerful trading platforms on the planet, and it's free for Schwab customers. So Schwab has this incredible dual personality. It's a fantastic, supportive place for a new long-term investor, but it also gives you the keys to a high-performance race car with thinkorswim if you ever decide you want to get into more active trading. Plus, their banking integration is seamless, making it easy to manage your entire financial life in one place. Now let's talk about the disruptors, starting with the one that made all the headlines, Robinhood. Robinhood's genius was its user interface. They made investing feel like a game. With a few taps, confetti rains down your screen, and you've just bought your first stock. They stripped away all the intimidating charts and jargon and created the simplest, most frictionless on-ramp to the stock market ever conceived. For millions of people, this was their very first experience with investing, and that is a powerful, positive thing. They also pioneered commission-free trading, forcing the entire industry to follow suit. But that simplicity comes with a cost. Robinhood has been at the center of multiple controversies, from the GameStop trading halts to their primary business model, which is called payment for order flow. That's a complex topic, but it essentially means they're incentivized to send your trades to certain market makers, and critics argue this may not always result in the best possible price for you. The gamified nature of the app can also encourage frequent, speculative trading, which is a proven way for most beginners to lose money. So, Robinhood is the easiest to use, but it might also be the easiest to get into trouble with. Then there's Webull. Think of Webull as Robinhood's more advanced older brother. It took the slick, mobile-first design of Robinhood but added way more horsepower. You get more advanced charting tools, more technical indicators, access to pre-market and after-hours trading, and a paper trading feature that lets you practice with fake money. It's designed to appeal to the active technical trader. Like Robinhood, it's commission-free and heavily relies on a slick mobile app. Their big marketing hook is offering free stocks for signing up and depositing money, which is a great perk. The downside is similar to Robinhood. The platform is built to encourage activity. It puts complex charts and real-time data front and center, which can be overwhelming for a true beginner and can tempt you into thinking you need to be trading constantly, when the real path to wealth is long-term, patient investing. It's for the beginner who wants to feel like a pro, but that can be a dangerous mindset to start with. So, how in the world do you choose? Let's filter out the noise and focus on what actually matters. There are 4 key questions you need to ask yourself. First, what is your investing style? Are you a passive, long-term investor who wants to buy and hold index funds for decades? If so, your decision is simple. Go with one of the big 3: Fidelity, Vanguard, or Schwab. Their focus on low-cost funds and long-term stability is perfectly aligned with your goal. If you see yourself as a more active trader who wants to buy and sell individual stocks frequently, then Webull or Schwab's thinkorswim platform are designed for you. Second, how important is customer service to you? When things go wrong, a trade doesn't execute, you can't figure out how to transfer money, you have a tax question, do you want to talk to a human being? If the answer is yes, then Fidelity and Schwab are your top choices hands down. Their customer support is legendary. With the app-based brokers like Robinhood and Webull, support is often through email or a chatbot, and it can be much harder to get a person on the line to resolve an urgent issue. Third, what do you want to invest in? All 5 will let you buy stocks and ETFs. But what if you want to invest in mutual funds, or bonds, or CDs? The legacy brokers Fidelity, Vanguard, and Schwab offer a massive universe of investment products. The newer apps are much more limited, focusing primarily on stocks, ETFs, and options. For a beginner, starting with one of the big 3 gives you maximum flexibility as your knowledge and your financial goals grow over time. You might not want mutual funds now, but it's great to have the option later without having to open a whole new account. And finally, the fourth and most important question: what are the real fees? I know they all say commission-free, but that's not the whole story. The thousands of dollars in fees I mentioned earlier don't come from commissions. They come from the hidden internal costs of the funds you choose to buy, known as the expense ratio. Let's say you invest $10,000. In a fund with a 1% expense ratio, you're paying $100 a year every year just for owning it. In one of Fidelity's zero funds, or a Vanguard ETF with a 0.03% expense ratio, you're paying $3 a year. That difference of $97 might not sound like much. But over 30 years with compound growth, that small difference can cost you tens, or even hundreds of thousands of dollars in lost returns. This is why choosing a broker with access to a wide variety of low-cost index funds and ETFs, like Fidelity and Vanguard, is the single most important financial decision you can make at this stage. So what's the verdict? For the vast majority of people watching this video, my recommendation is to start with Fidelity. It strikes the perfect balance. It's incredibly user-friendly for beginners. It offers the zero-fee funds that will save you a fortune. It has fantastic customer service, and it has the advanced tools you can grow into. It gives you all the power of a legacy institution with the modern feel of a new app. Okay, you've picked your champion. You've weighed the pros and cons and you're ready to go. But clicking sign up is just the first step. Next, we're going to walk through the actual application, line by line, and demystify the scary-sounding questions about your income, your net worth, your risk tolerance, and why the government absolutely needs your social security number. Get this part wrong, and your account could be delayed or even rejected. We'll make sure that doesn't happen. Let's break down this application question by question, because it's not just a form, it's a series of tripwires. And the first, biggest, and most intimidating one is that little box that asks for your social security number. Your heart rate probably just went up a little bit even hearing me say it. We are trained from childhood to guard that number like it's the launch code for a nuclear missile. You don't write it down, you don't say it over the phone, and you definitely don't just type it into a random website. So why in the world does a brokerage need it? There are two massive, non-negotiable reasons. First, the IRS. Uncle Sam, the tax man. Any money you make from investing, whether it's from selling a stock for a profit or receiving a dividend payment, is potentially taxable income. Your brokerage is required by federal law to report your gains and losses to the IRS. Without your social security number, which is your unique taxpayer identification number, they can't do that. It's the one and only number that links you, the citizen, to you, the taxpayer. Trying to open a brokerage account without it is like trying to get a driver's license without a name. It's the core of the entire system. The second reason is even more serious. The Patriot Act. After September 11th, a whole host of regulations were put in place to prevent money laundering and the financing of terrorism. A key part of this is the Know Your Customer, or KYC rule. Financial institutions, including your friendly neighborhood brokerage, have a legal obligation to verify that you are who you say you are. They need to ensure you're not on a government watch list or trying to move illicit funds. Your social security number, combined with your name, date of birth, and address, is the government-mandated way they confirm your identity. It's the ultimate background check. So when you see that box, don't think of it as a company being nosy. Think of it as a federal requirement like the security check at an airport. It's there for national security, and it's what keeps the entire financial system legitimate. Okay, deep breath. We've cleared the biggest hurdle. Now we get to the fun part, talking about money. The application is going to ask about your annual income and your net worth. This is where a lot of people freeze up. They either think, I don't make enough to be an investor, or I have no idea what my net worth is. Let's dismantle both of those fears right now. First, your income. The brokerage isn't judging you. They're not going to reject you if you're not a millionaire. They ask this for suitability reasons. It helps them understand your financial situation so they don't, for example, approve you for extremely risky trading strategies that could wipe out your entire year's salary. Be honest. If you have a regular job, just put your gross annual salary. If you're a freelancer or have variable income, make a reasonable, good faith estimate of what you expect to earn in a year. Don't lie and say you make $500,000 because that can get you into trouble later. But also don't stress about being accurate to the exact penny. A solid, honest estimate is all they need. Next, net worth. This sounds way more complicated than it is. Net worth is simply what you own minus what you owe. Your assets minus your liabilities. To get a rough estimate, you can do some quick back-of-the-napkin math. On the own side, add up the approximate value of your savings account, your checking account, your car if you have one, and any other major assets. On the O side, add up your student loans, any credit card debt, a car loan, and so on. Subtract the O number from the own number, and that's your net worth. For many people starting out, especially if you have student loans, this number might be 0 or even negative. And that is perfectly okay. Say it with me, it is okay. The brokerage knows this. They are not expecting every 22-year-old opening their first account to have a positive net worth. Again, they ask this for regulatory and suitability reasons. Just be honest. It's a snapshot of where you are today, not a judgment on your future potential. Now we move from the financial questions to the psychological ones. This is where they try to get inside your head. You'll see questions about your investment experience and your risk tolerance. These are critically important. Let's start with investment experience. The options will be something like none, limited, good, and extensive. If this is the first stock account you have ever opened, the answer is none. Do not let your ego get in the way. Do not say limited because you watched a couple of YouTube videos. There is zero shame in being a beginner. In fact, selecting none is a safety feature. By telling the brokerage you're new, you are preventing them from approving you for complex, high-risk financial instruments like options trading or futures contracts. These are things that can lose you more money than you even invested. Ticking none is like putting the training wheels on your financial bicycle. Protects you from yourself. Be brutally honest. Next, risk tolerance. This is the big one. They'll ask you to choose from a list that usually looks something like this: capital preservation, income, growth, and aggressive growth or speculation. This is Wall Street jargon for a simple question. How much sleep are you willing to lose over your money? Let's translate. Capital preservation means your number one goal is to not lose your original investment. You're terrified of losing money. You're okay with very, very low returns as long as your principal is safe. This is the financial equivalent of hiding your money under the mattress. Income means you want your investments to generate a regular paycheck, like through dividends. You're not necessarily looking for the stock price to skyrocket. You just want that steady cash flow. It's a conservative approach, but a step up from pure preservation. Growth is the sweet spot for most new investors. This means you are willing to take on a moderate amount of risk for the chance of your investment growing significantly over time. You understand that the market goes up and down, and you're okay with seeing your account value dip sometimes because you're focused on the long-term potential. Finally, aggressive growth or speculation. This is the high-risk, high-reward category. You're trying to hit home runs. You are willing to risk losing a substantial portion of your investment for the chance at explosive returns. This is not for beginners. So what should you choose? For 99% of people watching this, growth is the right answer. It signals that you're in this for the long haul and understand that markets fluctuate. It gives you the flexibility you need as a new investor without putting you in the riskiest categories. And here's the most important secret about this question. It's not permanent. You can log into your account settings and change your risk tolerance later, as you become more experienced and comfortable. So don't agonize over it. Pick growth and move on. The last few questions are usually simple housekeeping. They'll ask for your employment status, who you work for, and what you do. This is another KYC and anti-money laundering check. They'll also ask if you or a family member is a high-level executive or a major shareholder of a publicly traded company, or if you work for another brokerage firm. For the vast majority of us, the answer is a simple no. These are called affiliated person rules, and they're designed to prevent insider trading. Finally, you'll be asked to review everything. Read it over. Make sure your name is spelled correctly, your address is right, and your social security number is accurate. A simple typo here can cause massive delays. Once you're sure it's all correct, you'll electronically sign some documents by ticking a box and typing your name, and then you click Submit. The screen might show some digital confetti, a congratulations message. You've done it. You've navigated the bureaucratic maze. You've filled out the forms, answered the intrusive questions, and slain the application dragon. So that's it, right? You're officially an investor. Ready to buy Apple and Tesla? Not quite. Hitting Submit is a huge step, but it's the equivalent of graduating from the academy. You're not a pilot until you actually get in the cockpit and fly. Your application now goes into review, and there's one final crucial step that separates the window shoppers from the actual owners of the American economy. That final crucial step is funding your account. This is the moment of truth. It's the action that separates the dreamers from the doers. Up until this point, everything has been theoretical. You've filled out forms, you've answered questions, you've learned about account types. But it's all been preparation. Now it's time for execution. This is where you take your own hard-earned money and move it from the world you know, your checking or savings account, into the world of investing. And for many people, this is the single most intimidating part of the entire journey. It's the point where the fear kicks in, the self-doubt, the what if I lose it all monster that lives in the back of our minds starts to roar. Let's just acknowledge that feeling right now. It is completely 100% normal. Transferring money into a brokerage account for the first time feels like buying a one-way ticket to a country you've only ever read about in books. It's a commitment. It's a statement that you are serious about this. And that can be scary. But my goal right now is to pull back the curtain on this process, to show you exactly how it works, how simple it is, and how to do it in a way that puts you in complete control and removes that fear. So, how do you actually get money into your new account? There are a few standard ways, but one is by far the most common. It's called an ACH transfer, which stands for Automated Clearinghouse. That's just a fancy $50 term for a simple electronic link between your bank account and your brokerage account. This is the exact same system that handles direct deposits from your employer or automatic bill payments. You've used it 1,000 times without even knowing its name. It is the backbone of the American banking system. When you go to the fund account or make a deposit section of your new brokerage platform, this will almost always be the primary, recommended option. And it's usually free. The process is incredibly streamlined now. You'll be prompted to link your bank. You'll select your bank from a list. All the big ones are there: Chase, Bank of America, Wells Fargo, plus thousands of smaller local banks and credit unions. You'll then be asked to log into your bank using your normal online banking username and password. Now I know what you're thinking. Wait, I have to give my bank password to this other company? It's a valid concern. But you're not actually giving it to the brokerage. You're using a secure third-party service like Plaid or Yodlee, which are multi-billion-dollar financial technology companies that specialize in creating a secure, encrypted tunnel between your two accounts. They facilitate the handshake without ever storing or even seeing your login credentials. It's the industry standard and it is incredibly secure. Once you log in, you'll see your account's checking, savings, and you'll simply select the one you want to use to fund your brokerage. You click confirm and that's it. The link is made. For some banks, or if you prefer not to use the automated login, there's a slightly more old-school method: micro deposits. This is where the brokerage will send two tiny deposits, like 17 cents and 42 cents, to your bank account over the next day or two. Once you see them arrive, you go back to the brokerage website and enter those two exact amounts. It's like a secret code that proves you are the true owner of that bank account. Once you verify the amounts, the link is established. The other main options are wire transfers and mailing a check. A wire transfer is like an ACH transfer on steroids. It's much faster. The money is often there within a few hours, but it almost always comes with a fee, typically between $25 and $50, charged by your bank. This is really only used for very large, time-sensitive transfers. For your first deposit, an ACH transfer is perfect. And mailing a check, well, it works, but in today's world, it's like sending a message by carrier pigeon. It's slow and there are just better, faster, safer ways. So we've covered the how. Now we get to the biggest question of all. The one that paralyzes more new investors than any other. How much? How much money should you put in for your first deposit? The world of finance media has done us a great disservice here. We see headlines about Wall Street titans moving billions, and we see people on social media flexing huge account balances. It creates this myth that if you don't have $10,000, $50,000, or $100,000, you shouldn't even bother showing up. That is the single biggest lie in investing. It's like saying you need to be a Michelin star chef just to learn how to boil an egg. The truth is, the most important dollar you will ever invest is your first dollar. The amount is almost irrelevant. Thanks to the incredible innovation of fractional shares, which we'll dive into more later, you can now buy pieces of a company for as little as $1. You can own a slice of Apple or Amazon or Google for less than the cost of a cup of coffee. So, let's reframe the purpose of your first deposit. Your first deposit is not about trying to get rich. It is not about timing the market. It is not about making a killer trade that you'll tell your grandkids about. The purpose of your first deposit is to buy your education. It is your tuition for the real-world school of investing. It's about getting skin in the game. It's about building the habit and the muscle memory of paying yourself first. With that in mind, the answer to how much becomes much easier. It should be an amount that is meaningful enough for you to take it seriously, but not so large that it would cause you any financial stress or sleepless nights if the market went down. Let me say that again. Only invest money that you can afford to lose. This is non-negotiable. This is not your emergency fund, which should be sitting safely in a high-yield savings account. This is not your rent money. This is not the money you need for bills next month. This is designated long-term risk capital. For some people, that might be $1,000. For others, it might be $100. For someone else, it might be $25. The number doesn't matter. What matters is the action. Think about an amount of money you might spend on something discretionary. A nice dinner out. A new video game. A pair of sneakers. Could you take that amount and instead of consuming with it, use it to become an owner? If you start with $100, your goal isn't to turn it into $200 next month. Your goal is to learn. To learn how to place a trade. To learn what it feels like emotionally to see your account value go up one day and down the next. To learn how to read a stock quote and find information about a company. That $100 buys you a front row seat. It gets you off the sidelines and into the arena. Once you do that, you have fundamentally changed your relationship with money. Okay, so you've linked your bank account. You've decided on a starting amount, let's say $100. You've initiated the ACH transfer. You're done, right? Not quite. There's one last little waiting period. When you transfer money, it has to settle. This means it takes a few business days, usually 2 to 3, for the money to officially clear the banking system and become available for you to invest. This frustrates a lot of first-timers. They see the money has left their bank account, but they can't use it in their brokerage account yet. Feels like it's lost in limbo. It's not. It's just making its way through the plumbing of the financial system. Think of it like ordering a package online. The moment you click buy, the package isn't on your doorstep. There's a processing and shipping time. It's the same with money. Be patient. Your brokerage will clearly show you when your funds are settled and ready to be deployed. And then one morning you'll log in and you'll see it. Available to trade. $100. This is a moment to savor, because everything is different now. You are no longer just a consumer in the American economy. You are an owner. You have what Wall Street calls dry powder. You have capital. You have the ability with a few clicks of a button to buy a piece of the companies that make the phone in your pocket, the car you drive, the coffee you drink, the movies you watch. You have officially passed the final test. You've funded your account. You're standing at the threshold of the market. The keys are in your hand. The engine is running. But now you're looking at a dashboard with 1,000 buttons and dials. Thousands of stocks, ETFs, and funds are flashing before your eyes. A sea of green and red tickers. The power is officially in your hands. But with that power comes the most exciting, and perhaps the most paralyzing question of all. What on earth do you buy first? How do you actually place that trade? And how do you make sure your very first move isn't a massive mistake? Let's demystify this entire process right now. Think of your new brokerage account like the cockpit of a brand new car. It's sleek, it's powerful, and there are a lot of buttons. It's totally normal to feel a little intimidated. You have the keys, you've turned on the engine by funding the account, and now you're just sitting there afraid to put it in drive because you don't want to crash. My job is to be your driving instructor. We're going to ignore 90% of the confusing buttons and focus on the 3 things that matter: the steering wheel, the gas pedal, and the brake. First, the steering wheel. This is deciding where you want to go. What do you actually buy? For your very first investment, I am going to strongly, passionately advocate for you to keep it unbelievably simple. We are not trying to find the next Tesla or a hidden crypto gem. That's like trying to win a Formula One race on your first day of driver's edition. It's a recipe for disaster. Instead, our goal is to get on the highway safely and start moving in the right direction. The single best way for most beginners to do this is by buying a low-cost, broad market index fund ETF. Now, I know that sounds like a bunch of jargon, but it's incredibly simple. Let's break it down. An index fund just follows a big list of stocks like the S&P 500, which is a list of the 500 largest, most successful companies in America. An ETF, or exchange-traded fund, is just a package that holds all those stocks which you can buy and sell with a single click. So when you buy one share of an S&P 500 ETF, you're not betting on a single company. You're not buying just Apple or just Amazon. You are instantly buying a tiny slice of Apple and Amazon and Microsoft and Google and 496 other massive established companies. It is the definition of not putting all your eggs in one basket. You're basically buying the entire basket factory. It's the safest, most proven, and most recommended starting point for building long-term wealth. Think of it this way: your first investment shouldn't be a lottery ticket, it should be a building block. You'll see ticker symbols for these funds like VOO, which is Vanguard's S&P 500 ETF, or IVV from iShares, or SPY from State Street. They all do pretty much the exact same thing. For the sake of this example, let's say we've decided our destination is VOO. We've set our GPS. Now for the gas pedal and the brake. This is the actual trading screen. When you type VOO into the search bar of your Brokerage app, you'll be taken to a page with a chart and a big green buy button and a big red sell button. We're obviously focused on buy. When you tap it, a new screen will pop up. This is the dashboard, and this is where people get tripped up. But it's really only asking you two important questions. Question 1. How much do you want to buy? You'll usually see two options here. You can buy in terms of shares or in terms of dollars. Back in the day, you had to buy whole shares. If a stock was $500, you needed $500 to play. But today, thanks to something called fractional shares, you can ignore that. You can choose to invest by the dollar. This is a complete game changer. It means if you only have $50 or $20 or even just $5 to invest, you can still buy a piece of those great companies. You don't have to buy the whole pizza. You can just buy a slice. For your first trade, I recommend you switch the input to dollars and type in the amount you're comfortable with. Maybe it's $100, maybe it's $25. The amount doesn't matter as much as the act of getting started. Okay, so you've entered the dollar amount. Now comes the second and most critical question, the one that separates beginners from informed investors. What is your order type? This is the brake pedal. Controls how you buy. You will almost always see two main choices: market order and limit order. A market order is the default for many apps, and it's the simplest to understand. It basically tells the brokerage, I want to buy this stock right now at whatever the current price is. Just get it done. It's like telling a taxi driver, just get me to the airport. I don't care what the meter says. For a huge, heavily traded ETF like VOO, during the middle of a normal trading day, a market order is usually fine. The price you get will be very close to the price you see. But, and this is a huge but, the stock market is a live auction. Prices tick up and down every millisecond. If you place a market order for a more volatile stock, or you place it when the market is opening or closing and prices are flying around, you could experience something called slippage. That means the price could slip upwards in the split second between you hitting buy and the order actually getting filled. You could end up paying more than you expected. It's like flooring the gas pedal without looking at the speedometer. You'll get there fast, but you might not like the cost. That's why, as your instructor, I'm telling you to use the other option, the limit order. A limit order is your safety feature. It's your financial cruise control. A limit order tells the brokerage, I want to buy this stock, but I am only willing to pay up to a certain price. You set the limit. You are in control. So, let's say VOO is currently trading at $450.25 a share. If you place a market order, you might get it for $450.25 or $450.28, or if the price suddenly jumps, even $450.50. With a limit order, you can say, I want to buy this, but I will not pay more than $450.35. You set your maximum price. If the market price is at or below your limit, your order will get filled. If the market price suddenly spikes up past your limit, your order will simply wait patiently until the price comes back down. It protects you from getting a bad deal in a fast-moving market. For your very first trade, using a limit order is a fantastic habit to build. It teaches you discipline and control from day one. So you'll select limit order, look at the current price, and set your limit just a few cents above it. Say if it's trading at $450.25, set your limit to $450.35. This gives your order a very high chance of being filled immediately, while still protecting you from any sudden weird spikes. So let's recap the process. 1. You've picked your destination, an ETF like VOO. 2. You've hit the buy button. 3. You've typed in the dollar amount you want to invest, say $100. 4. You've selected limit order and set your maximum price just above the current market price. Now you'll see a button that says Review Order. This is the final step. This is you in the driver's seat, doing one last check of your mirrors before you merge onto the highway of investing. The review screen will summarize everything for you. You are about to buy $100 worth of VOO, using a limit order with a max price of $450.35. It will even estimate how many fractional shares you'll get. It might show a tiny commission fee, though for most major brokers today, it will say commission, $0. Take a deep breath. Read it over one more time. Does it all look correct? If it does, then you do it. You swipe up, or you tap that final button, submit order or place trade. And just like that, it's done. A message will pop up. Your order has been filled. Congratulations. Seriously, take a moment and let that sink in. You are no longer just a saver. You are an owner. You own a piece of the 500 largest companies in America. You didn't just open an account, you took action. You've officially put your money to work for you. That single click is a monumental step towards building a different financial future. But this is where the real journey begins. You've successfully merged onto the highway. So now what? Do you grab the steering wheel and swerve all over the road, checking your phone every 5 seconds to see if you're going faster? Do you panic and hit the brakes at the first sign of traffic? Or do you set the cruise control, relax, and focus on the long road ahead? Turning this one-time action into a consistent, automated, wealth-building machine is the secret. It's how you go from being a nervous first-time driver to a confident captain of your own financial destiny. And that is the final, most important piece of the puzzle. So what does that look like in practice? It looks like deciding right now that you are going to pay yourself first. Before the new sneakers, before the expensive coffee, before the subscription service you forgot you had. You decide on an amount. It could be $50, it could be $500, and you set up an automatic transfer from your bank account to your brokerage account every single payday. Then you set up an automatic investment from that cash into your chosen ETF or index fund. You set it and you forget it. This is not glamorous. There is no movie montage of you shouting buy, sell, into 2 phones at once. This is the quiet, disciplined, almost boring work of building real, lasting wealth. It's the financial equivalent of drinking water and getting 8 hours of sleep. It's not exciting, but it is profoundly effective. Your biggest enemy in this entire journey won't be the stock market. It won't be a recession. It won't be some slick Wall Street trader in a skyscraper. Your biggest enemy is you. It's the emotional, impulsive, scared part of your brain that will tell you to sell when the market is crashing. It's the greedy part of your brain that will see a friend get rich on a meme stock and tempt you to abandon your strategy and gamble. Discipline and automation are your shield against that enemy. You are taking your own worst instincts out of the equation. You are putting your financial future on autopilot, letting the system do the work, regardless of how you feel on any given day. Now let's talk about the monster under the bed. The thing that keeps most people from ever starting, the market crash. You will hear about it on the news. You will see red arrows everywhere. Your account value, which had been steadily climbing, will suddenly drop. It might drop 10%. It might drop 30%. And your gut reaction will be primal fear. You will want to pull your money out, to stop the bleeding, to run for the hills. I am telling you now so you can remember it in that moment of panic. That is the absolute worst thing you can do. I want you to reframe this. A market crash is not a crisis for the long-term investor. It is a sale. It is the stock market's Black Friday event. Every share of that S&P 500 index fund you love is suddenly 30% off. When your favorite store has a massive sale, do you run away screaming? No, you rush in to buy things you already wanted at a huge discount. This is the same principle. When you have your automated system running, what happens during a crash? Your automatic investment continues. But now, that same $50 buys you more shares than it did the month before. You are accumulating assets at bargain prices. And when the market, as it always has, eventually recovers, you will be launched so much further ahead than the person who panicked and sold at the bottom. Look at history. The dot-com bust in 2000. The financial crisis in 2008. The lightning-fast crash of 2020. People who stayed the course, who kept investing, who saw the panic as an opportunity, made fortunes. People who sold at the bottom locked in their losses and missed the incredible recovery that followed. Every single major downturn in U.S. stock market history has been followed by an eventual new all-time high. Every single one. Your job isn't to predict the crashes. Your job is to endure them. And your automated system is the key to that endurance. The second great temptation you will face is the lure of the shortcut. You'll hear stories of people making 100 times their money on a single stock pick or a cryptocurrency. Sounds amazing. Sounds like a cheat code for life. But for every one person who wins that lottery, there are thousands who get wiped out, who lose money they couldn't afford to lose. Trying to get rich quick in the market is like trying to grow a redwood tree in a week. You can dump all the fertilizer and miracle growth formula you want on it, but you'll just kill the sapling. Wealth, real generational wealth, is grown slowly, patiently, consistently. It's boring. And in the world of investing, boring is beautiful. Boring is powerful. Boring builds empires. Your simple, automated investment into a broad market index fund is your redwood sapling. Just plant it, water it consistently, and let time do the heavy lifting. If there is one sentence you burn into your brain from this entire video, let it be this: your success will be determined by time in the market, not timing the market. Let me say that again. Time in the market, not timing the market. Nobody can consistently predict what the market will do tomorrow, next week, or next year. Not the experts on TV, not your crypto-obsessed cousin, nobody. But we can know with a high degree of certainty the power of compound growth over long periods of time. The secret isn't being a genius who can predict the best days to invest. The secret is just being present for them. Studies have shown that if you missed just the 10 best days in the stock market over the last 20 years, your total returns would have been cut in half. Half? Think about that. Just 10 days out of more than 5,000 trading days determine 50% of the gains. You will never be able to guess which days those will be. But by staying invested consistently through the good times and the bad, you guarantee you'll be there when they happen. We've covered everything. Choosing a broker, the difference between a Roth IRA and a standard account, what an index fund is, and now the critical importance of automation and a long-term mindset. You are now armed with more practical financial knowledge than 90% of the population. The mystery has been stripped away. You can see the path. I want you to close your eyes for a second. Seriously, picture yourself 5 years from now. You kept up with your automated investments. You didn't do anything crazy. You just let the system work. You check your account and you see a number that makes you smile. A number that represents security. A down payment on a house. A quit my job fund. A safety net that lets you sleep better at night. Now, picture yourself 20 years from now. That small, consistent investment has been compounding relentlessly year after year. The growth is no longer linear. It's exponential. The money your money is making is now making more money than you are contributing. You've built a machine that runs on time and consistency, and its output is freedom. The freedom to choose your work, to travel, to retire early, to help your family, to live life completely on your own terms. That person, that future you, isn't hoping you'll become a stock market wizard. They're not hoping you pick the next big tech stock. They are just hoping, begging, that the you of today had the courage to start. To take the 15 minutes it takes to open the account. To set up that first automatic transfer, even if it was just $50. The knowledge is no longer the barrier. The tools are free and easier to use than ever before. The only thing standing between you and that future is a single decision. A single action. This isn't just about stocks and numbers on a screen. This is about buying back your time. This is about building a foundation so strong that the storms of life, a job loss, a medical emergency, can't shake it. It's about trading a little bit of your paycheck today for a whole lot of freedom tomorrow. You have everything you need. The plan is simple. The path is clear. Your journey to becoming an investor doesn't start when you've made your first million, or when you feel like an expert. It starts the moment you decide to open that account. So go. Start now. Your future self will thank you for it.